Karyn Cavanaugh, China is going through a growth crisis, but you remain bullish on the economy. Why is that?
Well, they are going through a growth crisis. They are slowing down. But even slowing down, they're growing faster than most other developed economies. And think about this. There's 1.3 billion consumers living in China. China is more of an export-driven economy. They're transitioning to a consumer-driven economy, and there's a lot of consumers in China. So overall, I think their growth is going to slow down, whether it's 7%, whether it's 5%. Nobody really knows for sure, but overall they are still growing, and it is a great long-term opportunity. Every company that wants to grow wants a footprint in China.
And what's the best way to invest in China considering the recent uncertainty, or should you wait a while and sit it out?
Well, the thing is not a lot of people are invested in the Chinese stock market. It's kind of hard to get into. It's not open to foreigners. And when the market was going up over 100%, nobody was saying, oh my gosh, look at China, isn't their economy doing well? And so thereby, when their stock market was going down, nobody should have been really panicking about it. I think the opportunity is for the companies, especially U.S. companies, that are going over there and doing business and growing their sales. So even if you're not investing directly in China, you are investing in the China growth story.
Well, perhaps the Fed was panicking as well because they were watching what happened over in China and they delayed the rate hike here, perhaps. So talk about China's impact on the American economy, because clearly the Fed's watching.
Well, the economy and the market are not necessarily the same things. China does not have a huge impact on U.S.'s economy. We don't sell that much stuff to China. So that's not really troubling me right now. I don't see that as a big hurdle that we have to get over in terms of our economy and our growth. But the market is a whole nother story. Markets move forward depending on the fundamentals, and that's earnings. So think about U.S. companies doing business in China. A lot of them are dependent on China for their growth, for their sales, and for their earnings. Especially tech companies, between 50 and 80%, some of these large tech companies, their earnings are from China. So that's why the market has been struggling, is that we have a strong dollar, we have a slowdown in China, we have low oil prices, and the earnings aren't moving forward. So that's why that's what I'm a little bit worried about, is that if China really does slow down a lot, it's really going to impact our markets in terms of earnings.
All right, well, let's talk a little about what you see as the bright spot over here, and that's the U.S. consumer.
Yeah.
So when you talk about the U.S. consumer, whether or not the U.S. consumer is enough to pull us out of this recent funk.
Well, U.S. consumer has been doing very well, and we've even seen consumer discretionary stocks are the bright spot of the market. And the U.S. consumer is doing well because what? Jobs market, employment is very strong, and housing is coming back. And a lot of people say, oh, housing, is that really important? Yeah, it absolutely is important. It's usually the consumer's #1 asset. So we have household wealth at all-time highs. We have a good employment market. We have low oil prices, which I don't know about you, but I just want to go out there and get a big car and drive all over the place. So the consumer is feeling very good, and they are 70% of our economy. In fact, if you ask a lot of consumers, they probably don't even, they're not watching what's going on in China. They're not even watching what's going on in the Fed. So the U.S. consumer is going to continue to do well as long as they have a job, their house is continuing to increase in value. So, and that's what the U.S. economy is based on. All
right, so putting it all together, what's the best way to invest here in the U.S.? Domestic strategy, I'd like to hear yours.
Well, domestic strategy, I think, you know what, it's a global economy. So if you're just going to stick in the U.S., stay in the U.S., you're probably going to be missing out on a lot of opportunity. Granted, emerging markets have been selling off, and everyone doesn't want to touch those with a 10-foot pole. However, there is a lot of opportunity out there. I think you should be globally diversified at all times, because that kind of helps you, it helps you smooth the bumps. Emerging markets, not so good this year. Last year, everyone said, oh, stay out of Europe. This year, Europe is the bright spot. If you're going to keep going back and forth and trying to time the market, you're probably not going to do very well. So I say you stay globally diversified. Stocks and bonds helps you ride out those rough times, because I think we are going to have some rough times. There's going to be more volatility. The Fed is backing off, market is normalizing, and normal markets are volatile.
All right, well, thanks a lot, Karyn.
Thank you, Greg.
Thank you for watching The Street.